The global financial landscape is currently engulfed in a state of profound and genuine uncertainty. This is not being used as a mere financial buzzword. It is a literal and clinical description of the conditions we are forced to navigate as we move into this critical window of March 2026. At Market Crux, our mandate is to look past the surface-level noise and analyze the structural shifts that define our economic reality. Currently, we are operating in a vacuum of clarity. Nobody truly knows how the escalating military friction in the Middle East will resolve. Nobody can predict with certainty what the upcoming Friday employment numbers will do to the trajectory of the US dollar index. And certainly, no analyst can tell you if the next major headline out of the Persian Gulf will send oil prices surging to $100 or retreating back towards 70. In such a volatile environment, patience is not a sign of hesitation or weakness. Patience is your ultimate strategic edge. The market in its current state is designed to identify and exploit every single weakness in a participant's plan. For short-term traders especially, if your strategy contains even a hint of ambiguity, if you are telling yourself that you will figure out the exit when you get there, or that you will hold just a little longer to see how it plays out, this environment will find that psychological crack, and it will widen it until your capital is liquidated. The survivors of this 2026 reset will not be the ones with the most elaborate or poetic theories. They will be the ones who knew exactly what they were doing before the price moved, not after the damage was done. Before we dive into the staggering data points regarding the silver market and global energy, I want you to join the conversation. Are you seeing this picture clearly, or is the mainstream noise clouding your judgment? Type "prepared" in the comments if you are following a plan, not just a hope. We read every single insight you share. Silver is sitting at $83 as of this recording. It has come off the recent highs of $86.90, and it is currently in a state of pullback. While the Western paper price reflected on your brokerage screens shows $83, the physical market in Shanghai is transacting at $95. This $12 premium is a glaring, undeniable signal that the paper price is one story, while the physical reality underneath is something else entirely. To understand the gravity of this disconnect, we must look at the plumbing of the exchange. The COMEX open interest. Total open interest on COMEX silver has plummeted to approximately 113,326 contracts. For context, we must look at the historical peaks. The all-time high was over 244,000 contracts, a level set back in February of 2020. What we are witnessing right now is the lowest level of participation in the paper silver market since September of 2013. The significance of this cannot be overstated. The paper market, the mechanism that sets the global reference price that the entire world follows, has lost more than half of its participants since its peak. Effectively, the gamblers are walking out of the casino. And as we know at Market Crux, when a rigged casino loses its players, it loses its fundamental power to set the line. Directly layered on top of this collapse in participation is the unprecedented drain on physical inventory. Total COMEX silver inventory now stands at 352 million ounces, marking a fresh one-year low. In a single day of trading, nearly 3 million ounces exited the exchange. If we widen our view to the last 30 days, we see that more than 53 million ounces have been drained, a 13% reduction in total inventory in just 1 month. However, the most critical number is the registered silver, the metal that is actually tagged and available for physical delivery against a contract. This category currently sits at only 87 million ounces. When you calculate the registered leverage ratio, the amount of contractual paper obligations sitting on top of the actual physical metal available, it comes to a staggering 6.68 to 1. This means that for every single ounce of physical silver that exists in a registered COMEX vault, there are over 6.5 ounces of paper promises demanding it. And that registered number is still in a state of decline. When a mainstream analyst tells you the physical market is fine, ask them to explain a 6.68 leverage ratio at a one-year inventory low, while millions of ounces are exiting the system in a single session. This data is public, but it is rarely highlighted in the mainstream. If you value this level of deep-dive institutional analysis, make sure you are subscribed to Market Crux and have notifications turned on. In a fast-moving market, the delay of an hour can be the difference between protection and loss. The delivery data further reveals that this is an institutional phenomenon. Over 600 silver delivery notices were issued this past Tuesday alone. Goldman Sachs was responsible for 400 of these, while Macquarie issued 200. On the stopping side, the side taking the metal, Bank of America and JP Morgan stopped nearly 340 contracts combined. Total March silver deliveries have now climbed to over 28 million ounces. This is not retail stacking in the traditional sense. These are global banking giants using the formal delivery mechanism to pull physical metal off the exchange and into private custody. They are not rolling their paper into the next month. They are standing for the metal because they understand that in a crisis, paper is a liability and physical is an asset. On the gold side, the trend is equally aggressive. Over 1,200 delivery notices were issued on Tuesday, with JP Morgan stopping the vast majority of those. The world's largest financial institutions are effectively de-risking their portfolios by converting paper claims into hard bullion. What makes these inventory drains even more remarkable is the retail context of the last few weeks. Since February 9th, retail investors sold approximately 15 million ounces of silver. In a healthy, balanced market, this influx of retail supply would have eased the pressure on lease rates and dampened the premium. It did not. The one-month silver lease rate remains elevated, and the one-year swap rate is still pricing in backwardation risk. The situation in China remains the leading indicator for global value. Silver inventories on the Shanghai Futures Exchange have fallen to 9.5 million ounces. With over 400,000 ounces being withdrawn in a single day, the math suggests that the exchange could be physically empty in less than 24 days. Combined Chinese inventory between the SGE and SHFE is now at its lowest level in a decade. The $12 Shanghai premium over Western spot has survived the recent paper sell-off. Physical buyers in the East are not transacting anywhere near the $83 price your brokerage is showing you. Either silver trades significantly higher in the West to attract new inventory, or Chinese authorities will be forced to halt withdrawals to protect their domestic supply. We must also analyze the massive shift in institutional ownership involving Jane Street. According to the latest 13F filings, Jane Street added over 20 million shares of the iShares Silver Trust, SLV, in the final quarter of 2025. This represents a 500-fold increase in their position in a single quarter. Jane Street is now the largest reported holder of SLV, surpassing even BlackRock. What is crucial to understand is that Jane Street is a firm where 87% of the portfolio is tied to options. They are structurally built to create and profit from massive volatility. When a firm with that specific architecture becomes the dominant equity holder in a physically backed silver ETF, the market must ask, which direction is the volatility bet? The custodian for this metal is JP Morgan, a bank that paid nearly $1 billion to settle federal charges related to precious metals spoofing in 2020. This is not a conspiracy theory. It is a documented federal case. Many in professional trading circles are now identifying price action patterns in silver that resemble previous patterns tied to volatility events in other asset classes like Bitcoin. While no formal investigation into silver specifically has been opened yet, the history of these players makes the current scrutiny impossible to ignore. Why is one of the world's most aggressive volatility firms suddenly the largest holder of paper silver? We want to hear your theories. Is this a long-term hedge, or the setup for a massive price suppression event? Drop your thoughts in the comments below. This is how we build the Market Crux community intelligence. Widening our frame at Market Crux, we see that silver does not exist in a vacuum. The energy picture converging right now is extraordinary. We are facing three simultaneous energy threats. First, the ongoing conflict in the Middle East and the threat to the Strait of Hormuz, which carries 20% of global energy supply. The Pentagon estimates this war is costing $1 billion per day. Iran has the capacity to produce 10,000 drones monthly at a cost of $35,000 each, while the US must use interceptor missiles costing millions. This economic asymmetry is a form of financial warfare. Goldman Sachs has explicitly stated that if the Hormuz disruption continues for 5 more weeks, Brent crude will likely reach $100. Second, 20% of global LNG supply went offline today, causing coal futures to surge 7% as the power sector scrambled for alternatives. Third, Russia has raised the possibility of rerouting gas away from Europe entirely. We have oil, LNG, and pipeline gas all under pressure at the same time. While headlines regarding Venezuelan oil provided a temporary psychological distraction, the market quickly realized that Venezuelan output cannot offset a structural disruption in the Strait of Hormuz. This environment is a modern echo of the 1970s blueprint, a decade defined by energy shocks, geopolitical fragmentation, dollar credibility pressure, and stagflation. The structure rhymes. Energy scarcity leads to monetary debasement, which leads to physical assets outperforming financial ones. The mainstream media will tell you, this time is different. But the data suggests that we are repeating a cycle of physical asset dominance. Stock markets in Korea and Dubai have already seen limit-down sessions, while U.S. equities remain green for now. Bitcoin is at $74,000, and gold is trading over $5,100. The announcement of naval escorts for maritime trade was a headline the oil market rejected immediately. Prices recovered every cent of their losses within hours, because the market knows that a naval escort cannot eliminate structural supply risks. From a technical perspective, silver has pulled back to $83, and the dollar index is in a state of consolidation. Until the DXY resolves its direction, short-term trading remains a low-probability endeavor. If the dollar index closes above its January levels, we expect renewed downward pressure on metals in the near term. In a genuine liquidity squeeze, forced liquidation affects all assets regardless of their fundamentals. With high-impact economic data due on Thursday and Friday, we strongly advise against the use of leverage in this headline-driven environment. Look at the price action across the board. It is choppy, directionless, and whipsawing on headlines that reverse within the hour. That is not a trading environment. It is a minefield. If someone is giving you high-confidence calls in this environment, they are likely selling something. Nobody has certainty here. Anyone claiming they do is not doing analysis. They are performing it. Long-term stackers, your job is to watch the instruments, the lease rates, the delivery notices, the SHFE withdrawal rate, and the Shanghai premium. These are the true signals of value. The paper price on your screen is merely the noise of a breaking system. Short-term traders, if you do not have a specific edge and a defined exit, you are gambling against a machine designed to exploit your emotions. At Market Crux, we prioritize logic over hype and hard data over headlines. Thank you for watching this deep dive. If this analysis gave you the clarity you were looking for, give this video a thumbs up and share it with someone who is still watching the 5-minute candles. Stay informed, protect your capital, and invest with logic, not hype. We will see you in the next update. Market Crux, signing off.